research by the World Bank, at present, as many as 66% of sub-Saharan Africans are listed as unbanked. In South Africa, the population of unbanked or underbanked individuals is currently estimated at roughly 11 million people. This is out of a population of roughly 58 million for the country as a whole. Now, when we reflect on why there's such a large unbanked population, for me this comes down to there being specific people or sectors where either A, the information required for traditional credit assessment models simply isn't available or doesn't produce an accurate reflection of those customers' creditworthiness. Or B, individuals or businesses where traditional credit models simply don't work for them, in that they don't, for example, have collateral to post, or they can't commit to scheduled capital repayments as you would need in the traditional space. But that doesn't mean that these individuals are inherently unbankable. When you consider the cost benefit for a traditional bank, it may not make sense for them to invest in the intellectual property, the time, the resources it would take to understand and be able to serve a niche group of customers that may not add meaningfully to their existing large asset base or to their bottom line. But for an alternative credit provider, this investment can be a lot more profitable. As an institutional investor with a largely developmental focus, we at Futuregrowth have been exposed to a number of alternative credit models as they come looking for funding. And today I'd like to share two such businesses with you. These are businesses within the space that I find particularly interesting. The first is Retail Capital. Retail Capital is a company whose core business is to support SMMEs' working capital needs. Now, we know that SMMEs are inherently risky. They often have highly unpredictable cash flows, so their ability to commit to scheduled debt repayments is often sketchy at best. So, particularly in the early stages of their business, SMMEs managing their working capital cycle is a big challenge. It's often a huge drain on their cash flows. And it's often cited as one of the key reasons that SMMEs actually fail. So the way that Retail Capital has managed to mitigate the risks associated with their target customer base is that they only provide loans to SMMEs with point-of-sales devices. So what this means is that to be funded by Retail Capital, you must earn some portion of your revenue through credit and debit card receipts. This allows Retail Capital to analyze the transaction history from those point-of-sales devices and on that basis calculate the company's average daily turnover, or card turnover at least. This amount is then used to model the amount of debt that Retail Capital thinks this company can comfortably take on. That amount plus a fee is then calculated as a fixed percentage of that entity's average daily turnover. It's then agreed with the entity and paid over to support their working capital needs. Each trading day thereafter, Retail Capital recoups their percentage of that business's card receipts until the time that the loan has been fully repaid. Now, the benefits of this model is that for the SMME, this method of repayment actually provides them with a counter-cyclical buffer of sorts, because during periods where their business is doing really well, they are actually paying off more of their loan, so that during periods where their business may not be doing so well, they're not burdened with scheduled debt repayments that they actually don't have the cash to repay. Then from Retail Capital's perspective, this model works particularly well because in periods where their business is doing well, or the other business is doing well, they are first in line to receive their cash flows before money can, sort of drain out of the company as it can do. Also, by improving the likelihood that these SMMEs succeed, Retail Capital essentially ensures that there's a strong and growing base of entrepreneurial businesses that will keep returning to Retail Capital for their ongoing funding needs as their businesses grow. Then the second example that I'd like to discuss is the Small Enterprise Foundation, or SEF. Patterned after the Grameen banking model in Bangladesh, SEF employs a group-based lending methodology to fund women in rural South Africa. This is a business that I'm particularly fond of. At present, SEF funds women who work in the informal sector of South Africa. So these would be a prime example of people who don't have 3 months bank statements or formal employment records that traditional lenders use to assess creditworthiness. And yet CEF has been funding these micro entrepreneurs for more than 20 years and has to date achieved average credit loss rates of under 2%. Now, for context, this is not wildly far off from the average loss rates experienced by the big 4 commercial banks, and is much lower than, for example, a Capitec, where their average credit losses are, I think, around 10%. So when I first heard about these incredibly low credit loss rates, I was intrigued and admittedly quite skeptical because, to me, I asked myself, how is this entity able to achieve such low credit losses when serving a demographic that is, to me, seemed inherently riskier? And the answer was remarkable to see in practice. So having recognized that they would never be able to perform a traditional credit assessment on these informal micro enterprises, they opted instead to rely on the credit assessment being performed by the people who know the community members best. And that is the fellow community members themselves. So the way that CEF operates is that potential loan beneficiaries must form themselves into groups of 5. These groups, once recognized by CEF after some kind of assessment, are then eligible to apply for loan funding, which they then collectively guarantee. What this means is that each member of the group is collectively on the hook for any loan taken out by another member of their group. So if one of their group members is unable to pay their loan for some reason, the rest of the group needs to step in and support that person to repay their loans. So what this means is that community members are particularly selective about who they'll form a group with, because nobody wants to be in a position where they have a bad apple in their group that they then need to support. It also means that they hold each other accountable. So they would make sure that their group member is using the loan for the intended purpose and not simply squandering it, or that the group member pays the loan on time and in full. A number of groups within an area is then formed into a center. Anytime one of the women wants to apply for a loan, they must present almost their investment case to the other groups within the center, who then discuss and either decide to approve or decline the loan. As part of our due diligence, I actually went to go and observe one of the center meetings, and that's where these pictures that you're looking at were taken. And it was remarkable to see the discipline, the pride, and the self-governance that was evident within that center meeting. I think one of the key contributors to CEF's ongoing success has been their understanding of the local context. So this model of peer support and, in essence, almost peer pressure, or the fear of being sort of shunned by the community if you're the one person not paying your loan, works in the particular communities that they serve. But it wouldn't necessarily work equally in any environment. Then, in addition, they've got a large branch infrastructure, and I think that's necessary for a business like CEF. So they've got field agents at each center that support the women and ensure that CEF's policies are being adhered to. And over and above that, there are multiple layers of oversight that ensure that CEF's policies are consistently applied across various branches and regions which are dispersed throughout South Africa. Obviously a hard thing to manage. Then, in addition to providing loan funding, they also ensure that each member has to take part in a savings and financial education program to improve the overall financial health and financial literacy of the women that they fund. So having considered these examples, it brings us to sort of a key question of what makes a good alternative credit model. For me, the key is in having identified a unique value proposition. The lender must have identified some unserved group or some unmet need and found an innovative way to serve that group. Then they must have tested the solution, either through pilot projects or by building up a loan book slowly and responsibly. They must understand the market. They need to understand the social context or understand the type of client that they're looking to serve. And they must have robust and appropriate credit scoring models. They need to then monitor this loan book and be able to tweak those credit scoring models as and when trends emerge. with the rise of digitization, artificial intelligence, machine learning, and so on, monitoring the loan book performance is an area that's showing a lot more opportunity. The ability for lenders to use the data, whatever relevant data they can find on their target customer base, and use that to make better credit decisions is one that we think will increasingly differentiate lending businesses of the future. Then any lending business needs to have appropriate capitalization, essentially meaning that they need to have enough equity to inject into this business to absorb credit losses as they inevitably will emerge. They need to be able to achieve scale. Any credit business is typically loss-making up front, as the costs of administering this business outweighs what you're earning on a small loan book. So they need to achieve scale in order to be profitable. And then prudent provisioning. Alternative credit providers must be realistic about the fact that some portion of their loan book is inevitably going to go bad, and must develop realistic expectations around how much they expect that to be. Then looking at what could go wrong with alternative credit. For us, the almost key pitfall that we've seen is that people think it's easy. People come up with some clever idea or identify some gap in the market, and they underestimate the complexity of actually managing a loan book or a credit business. So, yes, there may be a gap in the market, but how are you going to access your consumer? You need to have a distribution model that's appropriate for the people that you're looking to reach. And then administering a loan book is complex and costly. There are high operational costs associated with originating, monitoring, collecting on a loan book. Then achieving scale is not always as easy as people think it's going to be. And new entrants overestimate their ability to gear up their balance sheet, and they underestimate how difficult it actually is to fund a loan book growth. So having been sort of exposed to a number of different alternative credit models, the key things that we look to as institutional investors when considering whether to invest in these businesses is, first and foremost, character. We place a lot of reliance on who is running the business, what their track record is, and what their level of experience is. Then the use of funds. So, lending can be, or credit can be, a very contentious issue. And for us, it's very important that people are borrowing money for productive uses rather than for consumption. Then alignment of interest. We see it as particularly important that management have skin in the game. And so we almost as a deal breaker will always require that the people running the business have contributed of their own money as the equity tranche that will take losses before lenders. Then even filtering down to the incentivization of sales staff, alignment is often achieved by ensuring that the sales staff are incentivized based on qualitative metrics, that talk to the loan book's performance rather than just being incentivized to pump out loans, because that can encourage sort of, reckless lending. Then we'd often look for structural enhancements. And then a very key component for any business, and equally for any alternative credit model, is governance. A lot of investors see governance as sort of a softer issue, but for us, we believe that, firstly, as institutional investors, we have a fiduciary responsibility to allocate capital to companies that are sustainable and are responsible corporate citizens. Then, in addition to that, we also believe that ESG risks inevitably translate into financial risks over time. So, a good example of a sort of lending business falling foul of good governance is the old African bank, which was placed into curatorship a couple of years ago. Then, I've sort of presented a lot of information here, but when we think about alternative credit, I think something that I want to leave you with is the fact that no matter how technology may evolve or the needs of consumers and society may change, alternative credit is still credit. And so the key credit fundamentals still remain equally important. So for that reason, a lot of what I've said can be summarized in the 5 C's of credit that I learned when I was starting out as a credit analyst. These are character, capital, well, that's skin in the game, capacity, and that's where alternative credit models can assess that C, in more sort of creative ways. Then collateral, if any, and conditions, being just the overall state of the economic environment or, external factors that may make it a good or bad time to be entering a specific market. So, to close off, when reflecting on the statistics that I mentioned at the beginning of my talk and everything that has been discussed since then, I think it's clear that alternative credit is an area that has its fair share of risks and challenges. But I think it's also an area that's ripe for further innovation. If we wish to move towards a goal of inclusive and sustainable growth in South Africa or Africa as a whole, the people and businesses operating within the economy must have access to quality financial services that are appropriate for their needs. At their best, I believe that alternative credit models can enable new companies to serve the vast unbanked population in a way that is profitable and responsible, and can ultimately hope to move society towards an elusive goal of full financial inclusion. Thank you.